Welcome to Winning Wall Street's Money. Help support my channel. We need to get to 1,000 subscribers pretty much as soon as possible. So then I go live streaming because YouTube policy, they won't let me go live until I have 1,000 subscribers. Thank you to all the folks out there that have subscribed to my YouTube channel. If you have not yet, please take this moment now with helping me. Click subscribe. Next, click the bell. And next, click all. This helps you receive a notification when I post my next videos. Plus, click the thumbs up button and every time you watch my videos. If you got value from this video, if this was helpful, then please consider sharing a small monetary donation to my channel by going below and clicking on either my Patreon or PayPal links. If you join my Patreon page, then you'll get early access to these videos 24 hours before they're posted on the YouTube and lots more. If you prefer just leaving a small tip, click on PayPal. Either way, then you get that warm sense of satisfaction years down the line knowing that you helped me become a successful YouTuber.
Tuesday, July 12th, 1:34 p.m. New York time. Good afternoon, folks. This video is discussing options, beginner's guide. I'm going to go over briefly what I discussed in the past option videos. And we're going to now include as well as selling options. And I'll show you several examples with different underlying instruments. So basically, selling options and buying options. Again, not all brokers offer clients to be able to trade options. And not all brokers offer clients to trade options in different financial markets. What were some of the financial markets? Well, you have the futures markets that offer options, as well as you have the equity market offers options. So not all brokers even offer both those. Buying options and selling options. Buying options, for example, is buying call options or put options. Buying is debit. You have the money, you buy it. That's the cost. That's the risk. What you're paying for them, buying them at, is the max risk capital for that position. Selling options, you're required to have margin. If you have a broker that doesn't require you to have margin, that was interesting. Please point that out. Yeah. If you don't know what margin is, do some research. Get back to me. Let me know you understand it, because there's a lot of people who do research and still get the wrong information because they go to the wrong sources. I'm going to give you an example of buying options and selling options. Again, I said in the past, options are derivatives. So you have an automobile, you're buying assurance, you're paying maybe every month, every 3 months, every year for the whole policy. You're buying that assurance policy. That's a debit, you're paying for it. Well, the insurance companies receiving that premium, they're on the credit side. If you don't understand what I just say, listen to that again, because that's going to be the example that will work with the options. I will say that one more time. You have auto insurance, life insurance, health insurance, or insurance on some $20 product you bought at an electronics store. And you're buying that insurance, you're paying debit for it. And the other party that's selling to you, they're receiving it as a credit, as income. Take some financial classes, accounting. Hopefully they teach that at least in middle school. If not, call out your school board and the parents that voted for those knuckleheads. I approve that message. I'm not running for office. Well, options, being that they're derivatives, have time decay, just like your insurance policy. It might be a 1 month policy when you go on vacation, or 1 year for your automobile. Time decay. They are set per written out agreement what the expiration day is on that contract. So the person that's paying for them, it works against you, because as the time's decaying, you're losing value, understand that, of that dollar amount. So if you paid $100 and it was a 1 year policy and half it's gone, well, again, part of that premium you're paying melted away, versus the other side of the party that's selling it to you. As time decay goes away, you gave them 100 and now 50 bucks is left and you want to cancel your policy, they get to keep that 50 bucks, half that policy. It's very nice being on the side that's selling the options, collecting the credit. Okay, let's get into the options now. We're looking at 3 charts from the left to the middle to the right. Stock symbols Goth Mike Echo. Have you ever heard of it? Goth Mike Echo. GameStop. Have you ever been to a store? GameStop. Left chart 30-minute, middle chart daily, and the far right chart is weekly. Click on Trade tab. Look at that. It has options. Remember, not all stocks have options. I knew it already had options because I traded in the past. So real quick, bid and ask. Bid 138.87, ask 139.06. That's a wide spread. That's bad. Good for the bookie, good for the market maker, not good for the retail. Okay, so that's the underlining, GME, and that's the bid and ask for the underlining. But we're concerned about the options. So again, when I say the underlining, we're talking about the primary symbol. Well, right there. Look at these options. 15 July, 3 trading days. We're going to open this up. Left is the call, right is the puts. We'll keep this open to 40 strikes. 40 strikes. So the underlining is 138.91. Let's go close as possible. Look for 139 strike. There we are, 139 strike. On the left, if you're buying calls, it's priced at 560. Remember, 100 shares is each option. So that's $560. $560 if you buy the call option at that strike. The 139. If I want to go further away out of the money, let's go to the 150. Again, we're not at 150. The underlying is 138.98, but I'm going further out, the 150 strike. And if I want to buy that call option, it's 220. Let's go to the other side now. Puts. Puts, we'll go to the underlining. It's about 139. And if I'm bearish, I'm buying puts. You're buying at the ask, I have to pay $610. You got it? Yeah. If you want to buy a put, if I buy that 139 put, I'm paying $610. You need the $610. Buy that. First, if I'm bullish, I think price is going to go higher, then I'll buy the call option. Well, that 139 is 560. Now we're going to go a little bit advanced, just a little bit. Pay attention, folks. You'll be tested. If I'm bearish and think the underlying is going to go lower, yeah, if you think the underlying is going lower, that means you're bearish. Well, I could also trade options on the call side. Selling options. Yep, selling options, you collect the credit. So let me think about this. Am I bullish or bearish? GameStop. Irrelevant right now. I'm not trading it. But let's just say I'm bearish. The underlying is 139. Okay, so I'm going to sell the 139 strike. Well, when you sell options, you're selling them at the bid. Sell them at the bid. So that's 520. I collect 520 as a credit. That's a beautiful thing. That's a beautiful thing. On the other side, if I'm bullish and think it's going to go higher, I can sell put. Well, if I sell put, again, you're selling options at the bid. If I'm at the 139, I sell the bid. 580, I collect 580. Got it? Collecting it. Well, what's the risk? Let's go on the risk on this side first. 139. What's the highest the underlying price could go to? It's unlimited upside. Yeah, this could go to $1,000. Could go $1,000 today, tomorrow, next month. Who knows what price is going up to today, tomorrow, next day? But the risk to the upside is unlimited. You're exposed to all that risk because as the price goes higher, you're bleeding and you're bleeding faster. The faster this goes up, and your broker, again, you have to have a margin account to trade these when you're trading marginal products. So if this goes higher, the broker is going to either by default take your trade and close it mandatorily, or they're going to send you a notification that you have to send more money to your account. And that's when you turn off your phone, turn off your email, take your passport, and leave the country real fast. Wink, wink, like that ever happened. Wink, wink. First, now on the put side, if I sell a put, again, sell put on the bid for the put, well, the unlimited downside is it could only go to zero. You can't make you pay more than below a zero, okay? So again, you're using margins for these. And when you're selling puts, it's called selling naked puts. When you're selling call options, it's called selling naked call options. But a lot of brokers don't even know that term. So you just stick to the basic, or unless you're talking to someone like me, and then we'll have a funny conversation. Okay. So selling options. The beautiful thing is, if the stock stays at that price, and again, we have 3 trading days. If it would stay there for 3 trading days, remember, equity options, because this is equity, aka stock, it closes at 4 p.m. So on that 3rd trading day, at come 4 p.m., if this stock is still at this price or lower, you keep all that money you collected. All that money you collected. That's a beautiful thing. Right now it's at $495 you keep. That's a beautiful thing. Doesn't matter if it goes lower, goes down to 0, you still keep that. Verse, if you were bullish and sold the put, the 139 put, and if it goes lower, well, you still keep all that money you collected if you were stayed in it till expiration. But the risk is, because the underlining went below your short strike, they're going to deliver you for every contract 100 shares. So in your brokerage account, you're going to have 100 shares at GameStop. At 100 shares. And you would have bought them at $139. So that'd be $13,900. Yeah, so they're going to take $13,900 out of your account to pay for those 100 shares. So again, you have to have margin, and you have to have capital big enough to trade those underlying positions. Versus if it was a lower price stock, let's go look at a lower price stock. Maybe Robinhood, Hood. And let's see, the underlying's at 847. So let's look at 7. Got no premium. Let's go a little bit more. There we go. 8. So if you sell this 8 strike put, you'll collect $9. $9. Yes, it's 9 cents, but remember each contract's 100 shares, so it's $9. $9. And I don't know what your brokers charge, but there's fees and exchange fees, commissions and exchange fees for options. Most brokers charge, but there's definitely exchange fees. So are you collecting enough premium to cover it? Yeah, think about it. But anyway, if the stock goes down to $8 by the option expiration of that day and time, they'll deliver you 100 shares at $8. Well, that'd be right, $800. That costs $800. You have 100 shares. First, if you buy the stock right now at 847, and the stock goes down in 3 trading days to $8, well, you lost 47 cents a share. Excuse me. Yeah, that'd be a loser trade position. So logically, or someone that has experience would think, if I sold that 8 put, it's better selling that 8 put and still having the stock assigned to you because you kept that $9 versus if you bought the stock at 8 and it went down to 8 to 0 because you're losing that. But even though the stock gets assigned to you at 8, you still kept the $9. And when the stock gets assigned to you, you can do what you want with it, keep it or sell it. But if the stock's lower than 8, well, you're still losing. Okay, let's look at the upside. If you think Hood's going lower, you might be selling call options. We're almost done here, running out of time. So 846, maybe I think it's going to stay below $9 between now and then. I'll do the 9 strike, sell it at the bid, collect $7, and long stay below $9 by expiration, I'm winning. But you can trade these during the daytime too because they up and down. At the end, unlimited risk. If you sell the call 9 strike, and if it goes up the next day when you open your account, or the next week, or anyway, before it expires, and it goes up, oof, you're going to owe a lot of money to your margin, to your broker. Yeah. Okay, so that's basic selling options. There's a lot more to it. Stay tuned in the next videos. I'll update you more. Many thanks for watching.